when doctors want to see patterns or when they want to figure out what's going on in a person's body, they typically go through a procedure. They draw blood, they take pictures, whether those are x-rays or CTs or MRIs or PET scans. They put the patient through a set of procedures or tests so they can get a baseline of what's going on. And then over time, if the patient's not doing well, they continue to pull blood and take different types of images of the body. And the reason they do this is to find a pattern, right? To see if something has changed or what has changed that can help them diagnose and solve the problem. And that makes sense, because you can't just look at a body necessarily and tell what's going on, so you have to look inside of it. Well, price charts are our ability to look inside the stock market to see what's going on. We can look at different parts of it, and we can look at the stock market itself, which is nothing more than taking images or blood draws, metaphorically speaking, of people's financial belief of the future, right? You take hundreds of millions of people and you take their poll, you poll them on whether they think the future is going to be a little bit better or not, and that shows up in the price charts. And there are 3 types of price charts I want to show you today and see what they're saying. And these were 3 price charts that had a certain characteristic and kind of indicatorness, foresightness, whatever that word may be or phrase, that kind of said that maybe 2000 would be a bad year, 2000, 2001, and 2002. And then 2008, though it started at the end of 2007 and it ended near the beginning of 2009. But what are the indicators that can help us understand a little bit more about what the market is doing? Hey everybody, this is R.C. Peck, and this is my weekend podcast. And the theme of this weekend's podcast is financial clouds ahead. No question mark on the end of it. There are financial clouds ahead. Now, do those financial clouds crush the market and drop it down another 15% to the very peak of the 2000 high and the 2007 high, which is about on the S&P 500 at about the 1575 range? We don't know that yet, but there are 3 indicators that I want to share with you that are telling us that we still need to be cautious, because we have a lot of unsettled things in front of us that the clouds are telling us to, be cautious. So with that, let's talk about the first one, the one that has the most of my attention today, and it is the yield curve. Now, the yield curve might not seem that exciting to you or even to me, but it's really important because it tells us something very, very important about people and what people are believing about their future. So if you look on the price chart, at the very bottom, there's kind of a pinkish section. It's actually red, but just very transparent. And that represents when the yield curve is 0 or negative. Now, the yield curve is taking the yield on the 10-year Treasury. So if the 10-year Treasury was yielding 2%, and you subtract the yield on the 2-year Treasury. So if the yield on the 2-year Treasury was also 2%, this line that you see, the squiggly line that you see on the screen, would be below the 0 line right here, which is where my cursor is. And basically what that would be telling you is if someone's saying that they're willing to accept 2% from a 10-year Treasury and also 2% from a 2-year Treasury, that says they're really concerned. They just want to get their money back in 10 years. They're so concerned that, like, look, government, U.S. government, just take my money for 10 years. Yes, I can only give it to you for 2 years, but please take it for 10 years so I get that 2% for the next 10 years. That is someone who is scared about the next, say, 8-year difference between the 2-year and the 10-year. And if you look on the screen, you can see that the yield curve was falling, meaning the shorter term bonds were increasing in yield as the 10-year was either staying the same or decreasing. And the yield curve was was going more and more negative since 1996, 97, 98. It spiked up here when long-term capital management went belly up and almost took down the financial market, stabilized in 99, and then collapsed in 2000. Now, the S&P actually did not break down into the end of 2000. It was the NASDAQ that broke down in March of 2000, but all the other indexes did not change or fall until really the end of 2000. But look, the yield curve went negative, and just like it did in 2004, really dropping consistently through 2005, it went negative in 2006. And notice, now look, the Lehman crash did not really start until October. Well, the crash didn't start, but the market peaked actually right where my cursor is in October of 2007. And notice that the yield curve started already going back up. So the yield curve does not need to stay negative. In fact, it usually goes negative before market turmoil or at the same time. So what you see over here to the very right is you see a yield curve that has broken below what I consider a significant point, that 1.2%. It broke below it, and this is a weekly chart. So even on a weekly basis, the yield curve has clearly broken below this support line, which it tried to break below in 2015, in 2012, at the end of 2008, in the middle of 2008. It tried to get above it in 2001. So this ratio number matters, and when it breaks below, that means people are having more concern about the future, and they're saying, yes, I'll buy the 10-year Treasury at a much kind of relative lower yield to the 2-year, but it's because I think worse things are happening. And this is broken down. Now, does it mean the crash is going to happen tomorrow? Of course not. You can see that what happened to the yield curve here in 04, 05, 06. And look, the world thought everything was fine. But then the yield curve just jammed right up. We had the bottom of real estate, we had the top of real estate happen right here. And like I said before, in October of 2007 was the very tippy top of the stock market. So this indicator broke down, and that's not a good sign. That's saying people are more concerned about the future. The second indicator, which, maybe I'm stretching on the term indicator, is the Japanese yen. Now, why I have this on here is you may not buy the Japanese yen when you're concerned. You'll buy your local currency, but a large majority of the globe goes into the Japanese yen when they think there are storm clouds on the horizon, and they're just, let me just put my money in the yen. It's not really a stable currency. I mean, if you look at this screen, it's fallen 40% since the peak at the end of 2011. But to me, what's so interesting is it just kind of bottomed out here in 2015. And that's after the Japanese government was really trying to destroy the yen, and people still want it. And right here, this little blip down here in the channel was when the Japanese government came out a couple weeks ago and said, we're going to make our interest rates negative. And people are piling into this. So if people believe that the market is healing, the stock market is healing, then it doesn't make sense as much why people are piling into the Japanese yen and why the yield curve has broken below a significant support. Now, the third indicator, and again, put quotes around the word indicator, but the third indicator is gold. And if you look at this price chart, gold's been in a downward, a falling channel for 3 years on this screen. This is gold. And it has gone up 15% at the beginning of 2014, and it went up 15% near the end of 2014, but right through the beginning of 2015. And this time it looks a little different. It broke above its downward resistance line. Its downward trending, it broke above that downward trending resistance line. And if you can kind of see this, it has broken above, sat back down on the line, and moved higher. That is a very significant move when prices move out of channels, whether it's moving out to the upside or moving out to the downside, is to break out of it, sit back down on the line that used to be a ceiling, but now it's maybe a floor, and it's sitting on that. Now, we still want to see this. We still want to see gold break above this point. And you have to ask yourself, why would people be buying gold today? Now, I have a belief that the only reason people buy gold, and my belief is backed up by history and statistics and price charts, is people buy gold when they're just a little bit more concerned about the future. And over the last 4.5 years, people have not been that concerned about the future because there's been a lot of money printing and manipulation by central governments, central banks and central governments with what they're doing to interest rates. But according to this indicator in this price chart, that may be waning, that may be long in the tooth, it may be over. And what people are saying, free thinking people are saying, you know what, just in case, let me get some. And I can even show it to you on a weekly price chart. And why it's important on a weekly price chart is because if you're going to look at a breakout and want to confirm a breakout, you're going to want to see the breakout in price on a daily chart and a weekly chart. And if you look at this price chart, this is the same thing we were looking at a second ago. It just has deleted all the intra-week data and just put the closing price of gold in this case on the price chart to show you, and it is clearly broken out of its channel to the upside, as you can see that. And so why would people be buying gold now, and why would they break above this channel? And the answer almost always is there's a little bit more concern about the future. Now, if you were to say, or if someone were to say, well, look, the only reason gold's going up is because the US dollar is falling. Well, that's actually not true. Because if you look at 2015 and 2016, the US dollars, it's not doing anything. It's just sitting in this 7% channel and going up to 100, dropping down to about 93, and just kind of bobbing between there. It has not decided to break out to the upside yet, and it has not decided to break out to the downside yet. It is just kind of hanging out there. So for gold to break out, it strengthens the idea that people are increasing their worryingness about the future. And the US dollar has not collapsed or broken down with the Japanese yen moving higher. So that's another sense that, look, people are moving into the Japanese yen. People have already been moving into the US dollar. It's up 25% it went up 25% in about 6 months, and people are not necessarily selling out of that. So people have been moving into the US dollar before that, which is another sign that people are a little bit more concerned about the future than they were before. And that puts downward pressure on the stock market because people, they don't want to own stocks if they're concerned about the future necessarily. They want to own something that is more stable and that can guarantee that they'll get their money back. I mean, right now, today, the price to earnings ratio, the as reported price to earnings ratio, is around 22. And what that means is if you buy the S&P today and you're going to buy and hold it or buy and, forget it, that means it's going to take you about 20 years to get your money back. That's the way you want to look at the price to earnings ratio. That's about how long it will take you just to make your money back. That doesn't even include measuring inflation or the cost or your purchasing power. That's just looking at if there was no inflation. So there are some concerns. There are some indicators that are saying be cautious. Things haven't necessarily cleaned up. The market is at the bottom of its support channel right now. The S&P 500 is at the bottom of its support channel. So you want to still be cautious. So what's the takeaway? The takeaway is I think the market wants to go lower. I think it wants to go lower. It's like, look, let me go lower. Let me repair. It is healthy and normal for me to go lower. But the central banks want it to go higher. They want to have a little bit more stability for a little bit longer, hoping that people pay down their debts. And yes, there's 300% more debt on the planet than there was in 2008. But, maybe if the central banks can drop rates a little bit more and maybe print a little bit more money, maybe things can get cleaned up. I mean, after all, the U.S. government's been at this for 7 years, and it has produced a move higher in the stock market. But I bet if you were to poll most people in the United States, I would be willing to bet 90 or 95% of them would probably say they are poorer today than when the central bank started printing its first dollar. So the takeaway, we have volatility in front of us. Volatility has not gone away. Both the market is telling us there's volatility, and this just kind of this big long-term economic cycle we're in is saying that we're in a more volatile phase. So keep an eye on gold. I will for sure keep an eye on gold and the yield curve. The yield curve is a very powerful indicator that has gone negative before every recession, I believe since 1950 or for the last 50 years. I forgot whether it's for the last 50 years or since 1950, but it has been a very good indicator to recessions happening in the United States. And if you're like, who cares about recessions or how does that impact the stock market? The typical correction in the stock market when there's a recession in the economy is 34%. So that could be painful if someone were to lose a third of their money. Hey everybody, this is just another step in helping you protect your portfolio and protect and secure your future. Until next time, this is RC Peck.